Well, good afternoon, everybody, and welcome to the Wednesday Lunchtime Drive Through on Wednesday, September the 7th, 2022. We are just flying through this year. I'm Damon King. I'm your host. I'm a certified financial planner professional and wealth management advisor with ChappelWood Financial Services. We are investment advisors to millionaires. And this course is part of ChappelWood University, which is the educational branch of ChappelWood Financial. We love to educate as well as to help you manage your finances and help you build wealth and keep your wealth. See, that's the big thing, right? A lot of people have built the wealth. The real work is in keeping it over time. And today we're talking about can the market end up positive by the end of 2022? And right now, a lot of you may be thinking, I'm not sure I can take much more of this that we've experienced so far this year to maintain my wealth. I'm feeling a little bit shaky. Don't forget, you've experienced many of these times before, all right? Most people think about the big market declines, the Great Depression, the tech bubble, 2008. Those were cataclysmic events. But right now, what we're experiencing is a run-of-the-mill bear market. And those happen every 2 to 3 years. So, this is not something that is world-ending, world-shaking. It's painful. It's not any fun. It's not any fun for me. I don't enjoy sitting in front of my wonderful clients who have placed their trust in us here at ChappelWood to manage their funds. Well, when everything is down, it's tough. It's tough to stop the bleeding sometimes. And so I always like to come to you with some perspective. All right. I'm not just going to sugarcoat anything. There are things that I don't like about our current environment, but there's always room for optimism. And so today I wanted to investigate, can the market end up positive by the end of 2022? I actually was saying first quarter of this year that we still think the market will end up positive by the end of 2022. Do we believe that same thing? You got to stick around to find out the answer to that, because I am going to answer that question here in a little bit. As always, if you've got a question or you've got a comment, use the Q&A or chat button down on your toolbar. It should be at the bottom of your screen. Happy to answer any question or share any comment that you have here. So here we go. Let's get started. Will the market end positive? And specifically, I'm talking about the S&P 500. That's the index that most people look at to gauge the overall health of the United States stock market. However, here's my one disclaimer about placing all of your faith in the S&P 500. The S&P 500, big as it is, accounts for an extremely small percentage of the overall U.S. stock market. It is 500 companies, very large companies, but still 500 nonetheless, which is not a very big representation of the U.S. stock market. There are no small and medium-sized companies in the S&P 500. There are no international companies inside the S&P 500. There are no bonds tracked inside the S&P 500. When you get into retirement, you are likely going to have a decent helping of bonds. Well, you can't use the S&P to gauge that. You're probably going to have some international exposure, at least a little bit. You cannot use the S&P 500 to gauge that. If you want to get the broadest representation of the U.S. stock market, take a look at the Russell 3000 index. That tracks about 98% of the U.S. stock market. And now, that doesn't mean the Russell is looking any better. In fact, right now, let's take a look here. I'm going to look this up for you on the fly. The Russell 3000 index, and I want the Russell 2000. I want the Russell 3000. There we go. All right, so year to date, the Russell 3000 is down 18.49%. That's about what the S&P 500 is down. All right, so I'm not suggesting that there's not any correlation there, but the Russell 3000 does give a broader picture of the overall market. Needless to say, it's been a rough year. However, the reason that it does seem improbable that the S&P 500 is going to have a complete turnaround and turn positive from where it is right now is that as of September 6th of 2022, the S&P 500 needed to gain 21.5% from that point through December 31st just to break even for the year. That's a big mountain to climb, right? Since 1928, there have only been 3 other years when the S&P 500 had lost as much as it has this year through the second trading day of September. So whatever that usually, like the second or third or fourth, somewhere in that range, okay? Probably before Labor Day. So only 3 other times since 1928, almost 100 years, has the S&P 500 lost as much through before Labor Day. And in all 3 of those cases, it remains to be seen if this year is going to be number 4. But in all 3 of those cases where the S&P 500 had lost as much through Labor Day as we have this year, none of those 3 cases saw the S&P 500 reclaim all of that loss and turn positive. Okay, so that sounds pretty gloomy, right? But it's only 3 instances out of almost 100 years. All right, there are, what is that? It's 1928, so that's 94 years, right? Well, there are 90 other years in there. Can't count this year, it's not over. There are 90 other years to take a look at, okay? Plus, it's also just a 4-month window of time. So you can take all different kinds, look at different rolling 4-month periods of time. Any 4 months, you can roll them together, okay? We need to look more broadly to see, okay, how has the market performed in 4-month segments going back 90 plus years, all right? So if we look more broadly, what has the market done? Well, the picture changes a little bit. There is a chance that the market could end up positive or break even by the end of this year. Because also since 1928, if you look at all of the rolling 4-month periods, not just September through December, but January through April, February through May, that sort of thing, rolling 4-month periods, the S&P 500 gained at least 21.5% in that 4 months, 2.6% of the time. All right, so almost 3% of the time in rolling 4-month averages did the S&P 500 gain at least 21.5%. Now, I will admit to you, that's an extremely small probability, right? So basically, if we look at that history, it tells us that there's a 2.6% chance that between September 1 through December 31st of this year, that the market will gain back 21.5% or 21.6% to break even. Very small probability, but not impossible, because it has happened. What's important to remember is this: the market's future is in no way impacted by its past. You've heard it say before, past performance is not indicative of future results, all right, for the market itself. So whatever happened in the market 8 months before all of this has no bearing on what will happen over the next 4 months. Totally unrelated. It's just like flipping a coin, right? You could flip a quarter 1,000,000 times. Okay. Now the odds say that you're going to get heads 50-50, heads, tails 50-50. Flip it 1,000,000 times, flip it 10 times, flip it 3 times. It does not matter. Each past flip has no influence or impact on the outcome of the subsequent flips, right? Every flip is independent from one another. The odds are always the same, no matter how many times you flip it. And in many cases, the stock market is the same. We look at trends, certainly, to try to inform our decisions, because let's just call investing in the market what it is. It's educated future predicting, right? It's educated fortune telling. We're trying to tell the future by what has happened in the past, but we cannot tell the future of the market by what has happened in the market's past. However, what we can do is chart the future of the market based on how people have responded to its past. Does that make sense? The market is a non-living entity, but who participates in the market? Living, breathing, emotional human beings. So the market operates independently, but how we react to the past does often inform our future. So, for example, it's called societal risk. There are times when the stock market loses so much that everybody across society, every investor that's out there, regardless of their risk tolerance, becomes so gloomy, so pessimistic about what has happened in the past that it causes everybody to run for safety. And in that case, we would see a large enough market decline could cause society as a whole to seek less risk. And as a result, that would impact the future of the market, meaning that the market would continue to tank. Why? Because the market is a prediction of how we believe the future will look. And if we believe the future looks gloomy, if we're pessimistic about the future, the near future, our investing habits will reflect that, regardless of what the economy is doing usually, all right? But here's the thing. We haven't gotten anywhere near that point. We have nowhere near the tipping point for overall societal risk or the desire for everybody to look for safety. We're nowhere near that. People are still buying stocks. I promise you, a lot of you may have pulled out money or you've shifted to cash on some of your assets. There are a lot of people still buying, but we have seen a shift in what people are buying. Growth stocks, mostly technology. Those were the big winners the past 3 years, right? 2019, 20, and 21. We saw the market up all 3 of those years. And one of those years was the beginning of a global pandemic. And we had a deep recession, although it was short-lived. And the market was down over 30%. You think this is bad? Remember 2020? Remember May and June? Those were some dark days. We didn't know what was going to happen. At that time, the idea of a vaccine, we didn't know when it was going to come. It's easy to look back now and you forget, okay? We are creatures of the moment. You know, what have you done for me lately? You forget. That was very painful then. You didn't freak out too much then, or maybe you did, but you got through it. What we're experiencing right now, the market's down just a little more than half of what it was, actually about half of what it was during that time. So we're nowhere near a complete collapse of confidence in society. People are simply shifting what they're buying. Instead, they're not buying growth stocks, they're buying dividends. That is why dividend stocks have performed so much better this year than growth. Why have they shifted to dividends? Because dividends produce income. Dividend stocks give you an extra little added incentive for owning them. A little bit of stability, a little bit of security, dependability, predictability. When things are stable, predictable, and consistent, what does that do? That lowers your blood pressure, right? If you can count on something, you don't get nearly as concerned about it. So bad as this market decline has seemed, it is still considered a very common bear market. And we experience these every 2 to 3 years. If you're going to retire and, you want to plan to live, a decent length of time, you're probably going to experience 7, 8, maybe 10 bear markets within a 30-year period, maybe more. It's going to happen. All right. But we're nowhere near the level that society is just saying, that's it. Pardon me. We're out and that's it. We're not at that level yet. However, we have to acknowledge the market is still under pressure, right? There's still a lot of pressure out there. I did say at the beginning of the year that here at ChappelWood, we believed that the probability for the market to recover and go positive by the end of the year, I wasn't predicting double-digit returns. At first, I was predicting maybe 5 or 6% return, positive. Then as the year wore on, we got to the first quarter, we got to the second quarter, before we'd even seen the low point in June. Then we amended that to say, okay, maybe the market can eke out a 1 to 3% gain. All right. But a lot of those pressures are still there, and inflation is the primary one. The Federal Reserve has declared war on inflation, and they are going to crush it at all costs. What does that mean? It means they are going to continue raising interest rates until they get inflation back to their long-term target of 2%. Right now, it's just under 9%. It is falling slightly, but a big part of this slight decline is because we've seen energy prices come down. If oil were to spike back up again, then you would probably see inflation go up, because inflation is highly influenced by the price of energy. Energy flows through everything we do, right? Oil, gas, coal, whatever that might be. The economy is slowing. All right. I know many of you believe that the economy is in recession, that we've already had a recession. And you looked at the GDP number and it was 2 negative quarters of negative economic growth. That's one data point. All right. And again, I personally look at more data points than that. We look at more data points than that. We don't believe we're in a recession now, but we do believe a recession is coming. And we don't believe that we're in a recession right now because the things that we would need to see for a recession aren't there. GDP is one data point, but unemployment still very low. Consumer spending still very high. Consumer demand still very high. Those are not indicative of a recession. But what we are seeing is moving toward that. We are seeing spending begin to curb a little bit. It's starting to come down just a little bit. Saving is going up. When people start saving instead of spending, that causes the economy to begin shrinking. Economic shrinking is not the same as a recession. All right, or slowing, sorry, that is it. Economic slowing, growing at a slower growth, is not a recession. It just means the economy is growing at a slower pace. But the economy is slowing. Corporate earnings are beginning to shrink, or at least grow at a slower pace. And supply chains are still struggling. Consumer spending is strong, but saving is going up. All of these things are leading us toward what we believe will be a recession in 2023, especially if the Federal Reserve continues raising interest rates. In fact, at this point, we see it as a foregone conclusion. The only question is when. First quarter, second quarter of 2023, maybe third quarter. It's hard to tell at this point. The bottom line is the market is in for more volatility, probably for the next 6 to 8 months. This is not going to be over in December, at least the volatility. And volatility and market decline are not synonymous. A market decline tends to have volatility associated with it, but volatility are wild swings up, down, and up. The market can end positive, but it was really rocky getting there, right? So a market decline is not market volatility. Market volatility is simply a description of the path that the market took to get to wherever it went, whether it went up or down. And we're going to see more wild swings up and down. Why? Because the market is looking for direction, and more specifically, we as investors are looking for direction. What's going to happen here? How is this all going to play out? And right now, our best case is that there will be a recession at some point next year. Now, what does that mean for the market? Because a recession describes the economy, right? It's a shrinking in the growth of the economy. It's negative economic growth when you take into account several different factors. But the market measures something different. The economy measures what happened in the past. The market is an indication of what we believe about the future. We believe that the future is shaky, therefore the market is reflecting that. But generally, by the time a recession is declared, It's already happened. And usually the market's on its way back up. Because if investors believe, well, we've already hit the worst of it, now they start to feel optimistic. And what do? You want to take all that cash you may be sitting on, you want to buy stuff, right? When it's at a low point. So we believe we're in for more volatility maybe for the 6 to 8 months. What do we actually think will happen? So here's my answer. We actually believe now that a total turnaround is very unlikely. We believe right now there's just not enough confidence, there's not enough optimism, and there's not enough oomph for the S&P 500 to gain another 21.5% between now and the end of the year. However, there is enough oomph right now for a partial recovery of maybe 10 to 12%, predicated on inflation continuing to fall. If inflation continues to fall month over month relative to last year, okay, so remember what inflation, when you hear the inflation number, it's not a measurement of inflation from last month to this month. It's a measurement of prices at this time this year compared to the same time last year. At the beginning of 2022, those prices were being compared to the same time period in 2021, year over year. In 2021, we had not yet seen prices can go skyrocket because at that time we were still in the grips of COVID. The vaccine had just started coming out. The economic recovery was going gangbusters at that time, but prices were still very low. Interest rates were still very low. So obviously, if you compare an extremely low rate, low inflation month last year to a higher rate, higher price inflation period this year, well, inflation is going to skyrocket, right? But then as we go through this year, now we're getting into months where we're comparing high prices this year to prices at the same time last year that had already started going up. All right. So inflation in the back half of 2021 was much worse than it was in the first half. As a result, the difference between prices last year and the second half of 2021 compared to the second half of 2022, a much smaller gap. Ergo, inflation goes up at a slower rate. Okay. Now, that's overall inflation. And ultimately, what really matters for you, what you care about is, Damon, I really don't give a damn what you say about inflation. I'm paying more at the grocery store. Okay. Life costs me more right now. So don't tell me inflation's not bad. I'm not telling you it's not. It's rough. That's why the Federal Reserve is fighting like mad to get it down. And at this point, they're going scorched earth. Okay. This is an all-out war on inflation. And they don't care who they have to destroy or step on to get there. They're going to keep raising rates. But we do believe there's enough optimism out there that we could see a partial recovery of the market, 10 to 12%, if inflation continues to come down. And there's a decent chance, like I just said, that the inflation numbers compared to last year at the same time, in the last half of 2021, will go down. What we need is good news. The market or the public needs some good news, okay? And I don't want you to take this the wrong way. Please don't get offended when I say this. But something that would be beneficial to our plight overall would be to see unemployment actually go up. The Fed is actually trying to tighten the economy to the point that it triggers unemployment. It wants companies to lay people off. Not because they hate us, but because the Fed knows that so long as unemployment stays low, a lot of people are earning money. What are they going to do? They're going to spend it. And more spending stimulates the economy. At this point, what we need is a slowing economy. Because if we could get consumer spending down, then we would see prices come down. Supply and demand. And if demand begins to shrink and come more into line with supply, which is still struggling, we would see prices begin to fall. It's economics 101. It sounds terrible. It sounds inhumane. But one thing that could save our economy right now is for massive layoffs and to see consumer spending go down. Those are two things, I guess. I don't like the way the system works, but that's the way it works. All right. Since 1928, among all 4-month periods, the S&P rose 64% of the time. So there's some good news. If you look at all the rolling 4-month periods since 1928, 90 plus years, in 4-month increments, the S&P has risen 64% of those 4-month periods. All right, so a little better than half the time. So what should you be doing right now? Well, don't throw away your long-term plans for one. Don't just abandon your plans. But you should be taking some steps to de-risk. We've been doing this throughout the year for a lot of our clients. And we don't just give, this is not a blanket recommendation, okay? I'm not saying go out and de-risk right now. I have some clients, over the course of the year, we've had quarterly strategy meetings. They don't want to de-risk. They want max growth, and instead they're actually putting money into the market as opposed to dialing back. A lot of that is a function of your age, right? The younger you are, the more time you have. I'm 45. I'm pumping money into the market because I can buy it at a discount. But if I were 65, I would probably be doing what a lot of our clients who were at that same age in the 60s and 70s by de-risking a little bit. So what have we been doing? Well, in some cases, we've been looking at total protection, looking at indexed annuities, things like that for a portion of their money. Not a big portion, maybe a quarter, 20 to 25% of their money, totally protected, keeping the rest invested. In those investments, maybe we've been shifting away from growth to more dividends. We've been doing a lot of that, increasing dividend exposure, maintaining our stock exposure, but now shifting the kinds of stocks we own. And now we're not dependent upon the up and down in the market, but some of our growth is also coming from a consistent dividend. Other income producing assets, real estate, REITs, in an environment like this, if it generates income, then it's a helpful asset, right? Even bonds are producing income. They're getting hammered. If you hold on to bonds, interest rates go up, bond values go down. But keep in mind, if you hold a bond to its maturity, you're going to get all of your money back. It's when you sell before the term is up that you could potentially lose money. But if you're holding bonds for the relative safety compared to stocks and for the income, it's a good asset to own. Maybe look at some tactical strategies. We've been doing this as well. We have the ability for our clients to employ strategies that, as volatility in the market ebbs and flows, goes up and down, these strategies can move almost on a daily basis. Volatility goes down, we're buying. Volatility goes up, we're selling, and we're hoarding cash for a while until there's a time to buy. All right. So this is all very personal to you. It's all dependent upon how you feel right now, what you're trying to accomplish. If you're working with Chappell, many of you on the call, we've already done this, or it's already been happening inside your portfolio as a function of the active management you have. But if you don't work with ChappelWood, if you're not yet a member of the ChappelWood family, number one, message me, and I will share with you how to become a member of the ChappelWood family. And the other option is call your advisor and say, hey, look, I'm not suggesting, look, I know the market's down. I'm not going to freak out. I don't think I'm going to run out of money anytime soon. But I do see the train coming down the track. So what can we do right now to try to de-risk a little bit, to stop the bleeding? And I love that. I've got a client, Mary Sue, who used that term, and she's absolutely right. How do we stop the bleeding a little bit until the time comes that it's time to get back in the water, right? So if you're not concerned at all, then just stick to your plan, and maybe you should be buying. You know, it represents a great buying opportunity. All right. Are there any questions, any comments, any thoughts on what I've shared today? I'm looking to see here if we have any, if we have any questions. I don't see any questions at the moment. But if you do have any questions, then I encourage you, email me. You can email me at Damon, that's D-A-M-O-N, Damon at ChappelWood.com. I'm happy to answer any question you have. Of course, if you're a client of ChappelWood, well, you know where to find me anytime. I had a client just yesterday call up, and this is one of the great things about ChappelWood. I'll brag on us a little bit. A lot of you are with Vanguard or Fidelity or wherever, and that's fine. They're great companies. But the odds of you actually calling and getting your advisor on the phone sometimes are next to nil, right? I had a client call the other day. He's on vacation at his lake house, and he called up, and it was on the lunch hour. So I'm here by myself at the office. So I'm answering the phones. Okay, I'm not too good to answer the phones. And I pick up the phone. He said, well, Damon, I didn't expect to get you. I didn't think I'd get to talk to you. I'm like, but what do you mean you didn't think you'd get to talk to me? You think I'm going to ghost you? Of course you can talk to me. I'm here. I'm here all the time. In fact, I literally am here all the time. If I'm not at home during the week, I'm here. So you can call me anytime. All right, I don't see any questions. So I want to say thank you so much for joining us today. Hope that you enjoyed today's presentation. And, you know, we don't expect the market to turn positive by the end of the year, but we also don't think it's the end of the world either. All right. So thank you so much for watching. Enjoy the rest of your week. Stay safe, stay prosperous. And here's to you rocking your retirement. And thank you so much for joining us here at ChappelWood Financial. We are investment advisors to millionaires. We'll see you next time on the Wednesday Lunchtime Drive Through. Bye-bye.